Hello, this is Ahura from Otis Markets. Today is Friday, August 2nd, and the first Friday of the month. As you know, when at the first Friday, we have NFP numbers, and now we are going to check what we had as the numbers in NFP. Yeah, here, what we had as a data, and then we can check the market reaction. Here is the data. Surprise, the negative surprise here in the market we have. Uh, Unemployment rose to 4.3%. Why? Because we had only 114,000 newly created jobs in July. It is way lower than 188, 200,000 newly created job expectations. This is while the average earnings also increased only 0.2% per hour in July, which means only 3.6% in annual case. So generally, all the data and the private non-farm payrolls or private NFPs is 97,000. All the data, they show that the labor market is really weak. And now we can understand why Mr. Paul was telling in his press conference on Wednesday that if you remember it, he told in a press conference that there are some members that they were trying to convince the others to cut the rates in July meeting, not in September meeting. So why part of the FOMC members, they were trying to cut the rates on the July meeting? Because that's the reason, because the labor market is really weak. As you can see here, 4.3% unemployment rate is not what we were expecting in the US to see in 2024. The maximum, the lowest rate, unemployment rate that we could see, it was 4.1 and 4.2% for this year, and that was not higher than this. And now we can see that the unemployment rate at 4.3%, it is way less than, way higher than we were thinking. And 114,000 newly created jobs is surprise. And you know, it's for July, especially in July, because in July it's a summer, and usually in the summertime, we have too many short-term jobs for the summer jobs in the beaches, in the hotels, in the restaurants, in the cafes that they're hiring. But now we can see that that's somehow is confusing the market with the way lower than expected data. So that means central bank can be more dovish than we could expect. But still, we know the central bank already decided to cut the rates by 25 basis points in September. It is what we already know. And let's go and see the charts. Let's start with US dollar chart. If you remember, at the beginning of the week, when we were talking about week ahead, for the US dollar, the target was about 103, between 103.60 and 104. That was the target for this week, for end of the week. We are a little bit less than 103.60, but most probably we will have a little bit recovery, and we can end the week between 103.60 and 104 in this area. But generally, this data means that more dovish sentiment in the market, that central bank going to cut the rates. But this is what we knew already. We know already that the central bank going to cut the rate by 25 basis points in September. The percentage, the possibility of the cutting the rate more than 25 basis points in September, it's very low. So that's why that's why we already know that 25 basis point rate cut in September is possible. So it's already priced in the market. That's why this results, these numbers can mentally by psychologically can push the markets, the US dollar lower, but it doesn't mean that it can go way lower than this, much lower than this. So we can see again the US dollar around 103.60 and 104, because we have so many other risks in the market that they are increasing the demand for the US dollar risky safe haven demand. So That means pressure on the US dollar, but it's not going to be some special pressure or such a big pressure. So that's this such a big reaction to the market. It's the like first 1 hour of the market after data. It's always the you can see the reaction in the markets. Kind of the market can be overreacted. Same reaction we can see for the stock markets. As you know, these data means more dovish policies. More dovish policies supposed to be a positive for the stock markets because lower rates, more support from the economy. But you can see that the stock market is already the stock market didn't welcome to this number and it's again under pressure. But that has a reason. Because we already know that the central bank going to cut the risk by 25 basis points in September, so it's already pricing in the market. But still, that number could not be that much positive. But now that we have the unemployment rate at 4.3%, and we have only 114,000 newly created jobs. That's very negative surprise. It's like ultra negative surprise, which means the weak economy. When the economy just hired only 114,000 newly job, it's like hired just 114,000 people. That means that the economy is really suffering. When economy is suffering, it's not a good news for the stock market. So stock markets also can get under pressure. But at the same time, we have the reasons to be a positive also because the central bank is going to cut the rates. So this both sides, this like opposite sides, they can somehow just like overcome to each other, and the stock market can be a little bit negative. That means the stock market can be a little bit negative and can continue the overall downtrend, and just like don't just like don't focus on the first 1 or 2 hours reaction. This is general. When you go to the bigger picture, when you watch from the bigger picture, you can understand that that means rate cut. Rate cut is already pricing, so it's not a surprise. Yeah, overreaction the first hours normal, but generally it changed nothing because 25 basis point rate cut is something we already knew about that. So generally, but since as the data are very negative and the surprise negative, that's why we can say that it will pressure the stock markets a little bit more than it can help the stock market. So slow downtrend can continue. For US dollar again, since these data already rate cuts already priced in the market, psychologically it can pressure the stock, it can pressure US dollar lower, but which probably can end between 103 and 104. And for the next week, that can be the target, that can be the range. Then it can be our next range between 103.16 and 104, because this overreaction can balance over here, as already the central bank already announced its decision, and we know already what's going to happen, and we don't have a surprise, something special, big surprise here. This is already what the data had to tell us, and this is the market reaction. If you have any other question, don't forget to write down in the comments. I will try to get back to you as soon as possible. Have a good day. Bye.